joining in. Let's talk about technology now. Happiest Minds. Now, HDFC Securities, very recently, they've projected that the company's revenue growth will be 35 to 40% for FY25. The company also has an aspiration to hit $1 billion of top line by FY31. How's the demand environment? Just last week, we had Accenture reporting their numbers. We have with us Venkatraman Narayanan, Managing Director and the CFO of the company. Venkat, morning. This is Reema here. First, if you could categorize the demand environment for us. What has changed in the last 3 months, according to you? You're on mute.
Yeah, sorry. I'll talk specifically about our company. We started this year on the back of a decently strong year of FY24, where we did about 11.5% dollar growth. So that's the base on which we are now planning to build FY25. We've also started the year with 2 acquisitions, which are now in the process of getting integrated. So that's something that we are working on. And our organic growth engine, which is what contributed to the 11.5% last year, is continuing to fire. And we are looking at all of this put together, helping us achieve that number of about 35 to 40%, which I have called out as an estimate. I've not called it out as a guidance because there are certain puts and takes when you talk about acquisitions. So that's where we are for the year. Coming to the demand environment, we are seeing slow pickup, like other companies and what analysts have been saying. There could be a nice revival in the second half of this year. Like I've always been saying, you can't stay away from technology investments for more than 18 months at a max. You saw this during the COVID period. After COVID, investments into tech came back with a bang, and you had companies do brilliant growth. It's a similar situation. I think recessionary talk in the US, the dull business outlook of UK, the European region, and the interest rate scenario in the US. This has been what has been, taking all the headlines. And it's in that backdrop that IT companies have also not been given the credit for the growth that they have done in such a scenario. So a company like us, focusing largely on India, largely on US, but we have a disproportionate share in India, about 18-19% coming from India. We are well positioned, to participate in the return of growth, and also in the meanwhile continue to grow organically and inorganically.
35 to 40% estimate that you have, and not guidance, it includes or it factors in the sort of growth that you are expecting in the second half of this year, right? Or could there be an upside risk to this?
No. This is something that we are estimating as of where we stand today. So it includes both organic and very reasonably good inorganic growth bundled into it. So which is how we have always been giving our estimates. We have not broken our numbers.
And the PureSoft acquisition, because you said that this growth range is subject to completion of these acquisitions. Has that been closed completely? Because you were expected to close it by the end of last month.
Yeah, we have closed both the acquisitions. One is in the middle of last month, and the other is end of last month. So, from an accounting standpoint, that gets us close to 1.5 months revenue for one acquisition and about a month's revenue for the other. So both the acquisitions have closed. We have also intimated that to the exchanges. So now they are integral and they are a part of Happiest Minds, and they are doing decently well.
No, that's good to hear. And, gentlemen, morning, Mr. Narayanan, we're talking about being estimate 35-40% growth. You look at, I think when we talk about IT industry, we kind of paint a broad brush, right? You've got for some of the larger companies, we're talking about quarterly numbers, 2-3% kind of constant currency growth estimates, but you've got, your kind of growth rates as well. So, there's I guess it's a big market, and you got potential to grow, to scale, as you've said. I think you've got a slightly longer term guidance of about $1 billion, right?
That's right.
And yeah, but that's of course many years out. Why do you think, and this is of course not just about Happiest Minds, where there is of course just by the size is small, so there's many years of very strong growth. But why do you think growth will come back? Is it just the cyclicality effect in the second half, or are you actually seeing that? And can we extrapolate that for the industry as well? Or is it specific segments where you operate in, more discretionary, etc.? Go on.
Like I said, companies today are more tech-oriented. The technology is the company. It's no longer, one of the staff functions of a business. Technology is what makes a company. So if you look at it, healthcare has become health tech, manufacturing has become manufacturing tech, education has become edu tech, and so on. So, technology is now a binding factor, and it's a reason for companies to exist and grow. That aside, like I said, you can't stay away because technology obsolescence is so quick. You can't stay away from the market for more than 18 months. So when people talk about tech spend, they are talking about lights on kind of work. So what you have, you maintain, you try to fix it, you try to get the maximum out of it, ROI and investments that you have put in, you try to eke out of it. But if you have to grow, the companies, our customers have to grow, they have to, go deeper into technology, adopt AI, adopt analytics, adopt AI plus analytics, and quite a few of the new tech that's available to make sense of, the ever-changing customer requirements. So to that extent, you can stay away for about a period of 18 months. Now, like I said, macroeconomic factors have made sure that people they did not cancel any contract, but they started prioritizing. They looked at more lights on contracts, what is their core business, and that's what they were investing in the last 1 or 2 years. But 18 months now into this kind of trend, you have to open up new investments into tech because obsolescence comes in. The new business that they want to seek out needs that kind of tech investment. So it's only a matter of it coming back. I'm not so sure whether I should use the word cyclicality, like the infrastructure and the capital business. But yes, there are reasons. If there is a reason to hold back technology investments, there are very good reasons for the floodgates to open as well. So that's what I take
that point, but in the second half of the year is also the US election. Does that in any way impact the way clients will look to spend, or will they hold back till the verdict is out?
Politics and economics, they are getting disassociated largely, and this has happened in large markets, and it's happening in India, and you will see more of it. So there will be some sort of, noise, and there could be something on immigration policies and the like, but largely businesses drive their own agenda, and they have to make investments. They will make investments irrespective of the political dispensation. So yeah, there could be some small sort of disturbances, but that's for the now and here, but not for the long term.
Talk about generative AI, because unlike peers who predominantly set up a center of excellence, Happiest Minds has made Gen AI a business unit. What is your expectation from generative AI? Will you start, classifying it as a separate revenue line item? Will you be able to quantify the revenues coming in? And you've also got plans to ramp up hiring, particularly for the Gen AI business unit. So take us through those plans.
Yeah, so unlike other companies, most of them have set it up as a COE. You're absolutely right on that. But we said, let's be slightly different from others. We are putting it right in front of our business, making it a BU, leading it with an executive board member leading it. Our CTO is the CEO of that business. So the kind of investments and the market presence that we want felt is what we have tried to, build up through the setting it up as a BU. That's one. Second is, when it's a BU, it gets a lot more of attention and focus from the customer side. I'm not saying the COEs don't get it, but from a customer side, you see that exposure. There is a direct exposure, and that's kind of helping us, because most conversations today with customers and prospects start with Gen AI. While we talk about all our other businesses, they do want to know what we can do to help them with Gen AI. So that's something that we are seeing. Gen AI as a standalone, project is not what we are looking at. There will be wraparound projects with analytics, There could be other automation built around the generative AI solutions. So all of this will feed into the BU that we have set up, and we will be calling out separate numbers for that, because that's the way we are viewing our business, and that's the way we'll also have to publish our results. So calling it out as a BU will obviously make it incumbent upon us to disclose those numbers. So these are the
How soon before you will be able to quantify the revenues from Gen AI, and what is your own expectation? Because you have a guidance for this year, you have a $1 billion guidance for the next 6 years. How much will Gen AI contribute? And again, on hiring, if you could give us specific plans.
So we currently are about 100 plus people in the generative AI, the BU, close to 80 going to 100 very soon. We'll also be adding the analytics and AI into this as we disclose our numbers. Disclosing numbers, we'll make an attempt this quarter, or it will be the next quarter that we'll come back to, because we are just getting all our reporting alignment done, and those 2 acquisitions also need to be classified appropriately. So that will take us a quarter or 2. And what we are saying in terms of size is, the moment you call it a BU, it has to be a certain size. Otherwise, it doesn't gather attention. Today, PDES is about 80%. IMSS is about 20%. So Gen AI, if it has to become, it has to grab that attention from the customer side and also from us internally. It should become 10% over a period of time, 10 to 15% over a period of time, and in course of time, it becomes part of the mainstream business like IoT. So that's a number that I would like to hold out.
Okay, final question before we let you go. The $1 billion revenue target that you have, if you could break that up into the revenue contribution coming in from sectors, because you are moving away and increasing your weight towards BFSI as well as healthcare. So from the current mix, what is the target ideal mix going forward?
Yeah, so EduTech is about 24% today. BFSI and healthcare is about 14%. Post this acquisition, BFSI, EduTech, and healthcare would be of equal size or near about that. So they really become the lead story for our growth. Along with that, we are doing pretty well on manufacturing and consumer CPG, retail and CPG. So all of this will be the growth story. So high tech, manufacturing, CPG, retail, along with the 3, lead verticals of EduTech, BFSI, and healthcare would be what we'll be focusing on as we go forward. And as far as our target, that's more of a aspiration that we have put out there. It requires us to about 22% growth CAGR. Last year we did 11, and we are thereabouts in that number, and we want to keep that kind of growth thrust going forward for the next 5-6 years.
All right, so we'll leave it there. Thank you very much for joining us, and good luck. And we'll sort of, have you back soon once again as we track that recovery for IT services, as you outlined, perhaps starts next in the second half of this financial year. We'll take a quick commercial break here. Market